Hi there, it's Professor Monica Stockhausen, and welcome to Chapter 10, Understanding a Firm's Financial Statements. These are the statements that allow us to organize, synthesize, analyze, document all transactions, financial transactions, and organizations. So what do you say? Let's get right on into it. So just an introduction, the statements that we're going to go over are the balance sheet, statement of cash flows, and the income statement. So these are the three things that this PowerPoint in particular in this lecture is going to be speaking about. Moving right along. So we're going to first jump into the income statement, also known as the profit and loss statement. Yes, this language is interchangeable. So the income statement is really giving us an idea about our profitability in a given period of time. So it could be monthly, it could be quarterly, it could be annually, depending on how often you do that with your business. Something important to know with the income statement that it is a formula express. So when you see the actual income statement that I'm about to show you, just know it is an expression of the formula you see here below. Sales minus expenses equals profits, right? Generating the revenue minus expenses, the cost of goods it took to produce. So that's both variable and fixed costs, which I'll go into a little bit later, equals the profits or net income after taxes. Okay, so that is the income statement. It is a formula express, and that is the formula. Now, when we're looking at the income statement or why we do the income statement, the basic bottom line question is we're asking what, when we are doing the statement, is how profitable is the business and how can we make it more profitable, right? And so because of that, these are the things that we need to consider. How much revenue we're generating, the cost of producing those items and those units in order to be sold, the operating expenses it takes to maintain the business, the interest expense if we borrowed money, and the tax payments we need to pay to the city, state, federal. Quick overview of what you're about to see in the income statement is the sales. And remember, this is the formula, right? This is the formula express, so I don't want anyone getting overwhelmed. Sales, which is the revenue that you generated, minus, AKA less, cost of goods sold. Now, this area is usually called variable costs. You usually have variable costs, regular variable costs, and other variable costs. Now, this book tends to sum up a lot of things for good reason, but I want you to know that the cost of goods sold is usually under variable costs. Variable costs are costs that are dependent upon production. So the cost will vary depending upon how many items we sell, how many units we sell, generating how much we have generated in revenue. So obviously, it has everything to do with the cost of goods sold. So if we sold 500,000, 300,000, 20,000 in units, what was the cost to produce those things in order to get that revenue? So that would be a variable cost. Also, as a variable cost that's not listed here is commission, packaging, materials, things that directly or indirectly impact the way that we produce the actual item. Right. So usually I just want to give you a heads up that it's called variable costs and other variable costs. Variable costs are usually the materials used to produce the actual product or service. And then the other variable costs are usually the items that are indirectly associated with the product or service, but not the actual product or service. So it can be packaging, commission, anything to do with sales, things of that nature. So once you subtract sales minus the cost of goods sold or variable costs, you'll get your gross profit. And we're not done there. From the gross profit, you're going to then subtract your operating expenses, also known as fixed costs. Now, the fixed costs are not dependent upon production. This is important for you to know because whether you generate revenue or not, you have to pay these things. Be very cautious and very wary about adding on fixed costs because you have to pay them regardless. Professor Monica Stockhausen, what are examples of fixed costs? So it says here, generally speaking, marketing, selling, things of that nature, but specifically it's salaries, it's rents, it's utilities. Sometimes I argue that utilities is both variable. It's both a variable and fixed cost. Sometimes I call it a mixed cost because in some firms, it does depend on production, the use of your utilities, right? So salaries, rent, depreciation, insurance, marketing, things of that nature, these are fixed costs, also known as operating costs, as you see right here. So the operating costs, you have to calculate the total of that. And then it's equal to the operating profit. So you have the gross profits minus operating expenses equals operating profits. So then the operating profits subtracted by any interest expense. So this is the financing activity. Excuse me, the financing activity. Sorry, I get so excited. I start talking so fast. So within the financing activities, you have interest. You have interest that you. Apologies for that awkward pause. I have a puppy and he likes to get into everything. So here I go. So within the financing activities, we have interest expense. This is interest accrued from any loans that we have in regards to operating. So if we took out any loans to produce any of the cost of the units or any items or marketing or rent or anything like that, the interest accrued would be here. We subtract that from our operating profits and we get our profit before taxes. Profit before taxes subtracted by the taxes of the state equals the net profits. After you get the net profits, you are free to invest that back into the business, or you can pay out dividends to your shareholders. Now, you're not illegally obliged to pay out dividends, but it would be in your best interest to pay out dividends to your shareholders. So just consider that after net profits, you would either invest it back, pay yourself, or pay out to shareholders. So this is vocabulary for you. I just went over all of this already in the overview. So I'm not going to go over each and every one. This PowerPoint will be uploaded into the file section of Canvas. So if you want to go over and know the verbiage that I used and specifically what it was used for, you can see it here. But I'm going to go ahead and skip that because I went over it in the overview just now. So let's look at a real income statement of a fake company, J.M. Dalton Incorporated. So as you can see at the top of the statement, it's sales, right? Because this is the formula expressed. The sales is $850,000. I would love to know what they sell because I would love to generate $850,000 in revenue. Anyway, that's besides the point. So, so you have the sales at $850,000. It's 100% of sales. Now, 65% of that is the cost of goods sold. I love that this income statement actually shows the gross profit margin. So it's the percentage. It's the sales in a percentage format. Okay, and this gives business owners a little bit more insight than just saying we had to subtract $550,000 in expenses. When we say we have to subtract 65% of our sales and expenses, that gives us a little bit more insight maybe that we need to look at our expenses and figure out if we can cut our costs in any way. So anywho, $850,000 in revenue, $550,000 in expenses gives you a gross profit, remember, gross profit of $300,000. So at this point in time, their gross profit margin is about 35%, which is really low. They really need to consider looking at their expenses and cutting costs while maintaining some value in the firm's product or service. Not sure what the product or service is for J.M. Dalton. This is straight from the book, but this would be the data you would use to reconsider your expenses. Now, after sales minus cost of goods sold equals gross profits, we now calculate in our fixed costs, which is our operating expenses. So within the operating expenses, you have your marketing expenses, general administrative, so sales, rent, so on and so forth, depreciation, so the loss of value in certain assets, that is calculated here. I'm going to go deeper into how we calculate the depreciation a little later in the balance sheet. So once you total that, you have a total operating expenses, which is $200,000. Operating profits are now $100,000. So what they did was take the $300,000 subtracted by the $200,000. So the gross profit subtracted by the total operating expenses. Now we're at $100,000, which tells us that we have only about a 12% now, and profit margin is getting lower and lower, as you can see. Now, you want to subtract the financing activities, which is the interest expense, any interest accrued that we owe. The profit before taxes is now $80,000. You have to pay your taxes. The net profit is $60,000. So it's about 7% net profit, selling 7% from the sales. Ladies and gentlemen, do you see that? This gives so much insight to the owner, right? On how we are running our business. And if there's room for optimization, and that, as you can see, there's much room for optimization with JM Dalton. So the net profits are 60,000. Now, again, once you have that net profit, you can choose to invest it back in the business, or you can pay out dividends. As you can see, dividends are the return on investment for shareholders and investors. So there they do it at $50,000, and then the additional retained earnings is $45,000. So they went from $850,000 to $45,000 in retained earnings. I'm not sure exactly what their units are and what they're producing, but their expenses are extremely high. So there would be a lot of reconsideration done in operating in the operating area of their business. This is more vocabulary for you, but I'm going to go through this one because depreciation can get a little complicated in how we calculate that. So let's start there with depreciation expense. Just know that depreciation really means that there is a loss of value of original value of a certain asset. So this could be a vehicle, this could be a building, this could be equipment. There's an argument over land. Land is supposed to appreciate, not depreciate, but it really depends on natural factors as well. And so you really want to consider over time, how valuable is this particular asset? And there are many ways to calculate depreciation, but the most common way is the straight line depreciation, where we're looking at the original cost of the asset, subtracted by the salvage value, divided by the useful life. If you can hear my dog, I'm so sorry. He is upset that I'm not giving him any time right now. So let me pause yet again to make sure that he gets outside. Okay, so I'm back. Okay, so where I left off is the straight line depreciation. So it's the original cost of the depreciation, the original cost of the asset. So let's say we decided that the asset is a car, and the original price for the car is, I don't know, $35,000, right? You would subtract it by the salvage value, in that part you have to do your R&D, your research, and then you have. So the straight line depreciation formula allows you to calculate how much value is going to be lost each year on your asset. And now there are multiple ways to calculate the depreciation expense. However, this is the most common one. It is the original cost of the depreciation, of the asset minus the salvage value, in which the salvage value is what you can sell it for, the value of it at the end of its useful life. And the useful life, it could be, depending on the asset, could be anywhere from 5, 10, 20, 40 years, depending on the asset. So it's the original cost of the item minus the salvage value divided by the useful life. So for example, let's say it's a car, $35,000 you bought it for. Maybe the car has a useful life of 10 years, depending on if it's a Toyota or not. And then maybe the salvage value at the end of the 10 years is probably, maybe you can sell it for $2-3 grand, right? Just say $2 grand. So you're left with 33,000 divided by 10 years is about 3,300. Hope my math is right. Just did that in my head. $3,300 that you have to subtract from the original cost every year to make sure that you have the accurate value, right? So that's the expense that you need to consider, the loss of value of that equipment or building. Now, the next item in verbiage you need to be aware of is the profit margin, which I talked about in the actual, when we were talking about the income statement earlier. It's the profits as a percentage of sales. So it gives you a little bit more insight into the room that we have to either decrease expenses and increase profitability. So this includes, obviously, you saw in the statement, gross profit margin, operating profit margin, and net profit margin. And then you have the dividends, which is the return on investment paid out to its owner. So these are the people who have invested interest, financial invested interest into the business, and want to have a return on investments. When you pay that out with your net profit, that is called the dividend. Again, there's going to be many of these slides that have vocabulary for you. I won't go through each and every one of them because this PowerPoint will be uploaded. But the things that are a little bit more difficult, I will explain in this lecture. So now let's get into the balance sheet. This gives owners a financial report of your organization's financial position and financial health at a specific point in time. So while the income statement is showing our profitability in a month, a year, or a quarter, the balance sheet is showing us a month, a year, or a quarter, a year, excuse me, a month or a quarter, a year, in the health of the financial position of the balance sheet. All right, so now we're looking at the balance sheet. This is a financial report and statement that is also a formula that is expressed. So if you see at the bottom right there, you'll see it's total assets equals debt plus owner's equity. Okay, so again, just like the income statement, it is a formula expressed. So when you see the statement, don't get overwhelmed. It is literal expression of the total assets the firm owns equals the total debt and owner's equity. I'm going to go into the verbiage and what these things mean in a second. So the biggest difference between the balance sheet and the income statement is that while the income statement is showing profitability, the balance sheet is showing me my financial position and health of my organization at a specific point in time. So we're looking at the assets that we own, the things that we own in the company. We're looking at the things that we owe and the amount of investment that we have per our shareholders, the owner's investment, owner's equity. And so again, the formula is total assets equals debt plus owner's equity, because get this, we wouldn't have any assets, houses, buildings, equipment, land, anything like that if it wasn't financed with either capital cash from our owner or from the owner itself or from debt that we borrowed, right? So in the balance sheet, it's important for you to note that the numbers at the bottom, and you'll see this in a second, the total assets and total debt and equity altogether must equal each other. If not, there is some inaccuracies that you have to review. So just to break it down a little bit further about the financial position, you're probably like, well, what does that mean? You know, what is it that I actually get to see when I do a balance sheet for my company? One is the total amount of beginning and ending assets. So you know the original cost of the assets, and then you know the true cost, the more accurate cost in that specific time. You also get to know how much has been invested by current assets and fixed assets, how much debt and equity were used to finance those assets, how much of the equity came from investments made by the owner, common stock, or just retained earnings, the net profit, and then any changes in the amounts between the two dates. So obviously we do balance sheets for a particular reason, for comparability. We want to compare year by year to see has there been a decrease or increase in our assets or debt or equity. So it really helps the business owner to realize what strengths we have, what leverage we have in our business, how much assets, how much things that we own, how much things that we owe, to really figure out how can we position ourselves better in the marketplace. So within the balance sheet, of course, as I said previously, we're going to be looking at assets, debts, and owner equities because those are the components of the formula. So when we talk about assets, know that we're talking about very specific assets, current, fixed, and others. You may have seen it different. You probably have seen short-term assets or long-term assets. That's totally fine. We're talking about the same thing, okay? So when we're looking at current assets, I'm going to go through this fairly quickly, only because, you know, I'm going to upload this PowerPoint to Canvas, and it's just basic vocabulary, but I'm going to expand on the things that may be a little bit confusing. So the current assets are assets that can be converted into cash very quickly within 12 months. So when we're talking about the things that the company owns, it's the cash that they have on hand, it's the accounts receivable, any credit extended to customers that is still owed to the company, and any inventory, supplies, anything in regards to the products that is held by the firm that the company owns. And the fixed assets, these are assets that are a little bit more long-term. So these are the property, the equipment, the cars, the buildings. And in this case, this is where depreciation comes in, where we are subtracting the annual expense or value, less of value over time to make sure we have an accurate value of that asset. Um, know for vocabulary reason that the original cost is also known as gross fixed asset. So if you see that verbiage, know that they're speaking to the original cost of the asset before it was depreciated. Right. So when we talk about straight line depreciation, the original cost minus salvage value, you can easily replace original cost with gross fixed asset minus salvage value. Okay. I hope that makes sense. Other verbiage that you need to know is a cumulative depreciation. So it's the total depreciation expense taken over over an asset's life. So in some balance sheets, you'll see that they will do the entire over the entire useful life of depreciation. So it'll be 33,000 divided by, I mean, excuse me, 33,000 less than the original cost. So I'm using the same example that we had as for the vehicle. So let's say the vehicle was 35,000, but the salvage value after the salvage values be 33,000, 3,300 times 10. Other vocabulary that you need to be aware of is a cumulative depreciation in net fixed asset. So know that on the balance sheet, they're usually not going to take the annual cost every single time from the original cost or the gross fixed asset cost. They're usually going to give you the cumulative total. So, for example, with the vehicle example that I gave previously, usually ideally you would subtract the 3,300 every single year, but no, instead you're going to subtract the entire accumulation over 10 years, that whole amount from the asset, and that will be listed on the balance sheet. I think that was kind of confusing, but let me know. You can always ask me in the messages if that was confusing. The next thing is the net fixed asset, which is the gross fixed asset, which is the original cost of the asset subtracted by the cumulative depreciation, which I just said, right? That's going to be listed in the actual statement. Now, other assets are the more intangible assets. So we had current, we had fixed, right? We had current things that we own that can be converted into cash within 1 year, fixed that are more long-term. And then we have other assets that are not so tangible. So patents, trademarks, copyrights, things of that nature. So on the other side of the balance sheet, consider the formula, right? Total assets. So we talked about the assets on the left side. On the right side is the actual debt and equity. So the right side of the balance sheet showing debt and equity indicates the firm financial, its firm's financing for its assets. Remember, the reason we have these assets, the buildings, the vehicles, so on and so forth, is because we either finance them with the capital we have from the owner's equity or debt itself. Okay, so when we're talking about the depth, it is categorized in current depth or short-term debts and long-term debts. So current debts are the debt that we owe within, it needs to be repaid within 12 months. So this is accounts payable, which is any outstanding credit that is owed. So if we owe money, if we have a line of credit with someone else, suppliers, manufacturers, whomever it is, which is the exact opposite of accounts receivable, which is money that is owed to us. Accrued expenses. So this is operating expenses that have been incurred but not paid. This is very different from cash expenses because in accounting, there are two ways to document financial transactions within financial statements. One is accrued and one is cash. Now, the biggest difference is that with cash method, nothing is documented unless it is actually paid, right? Accrued is different. If it has been incurred, whether it's been paid or not, it will be documented. And most companies use accrued to make sure that we're keeping eye on all expenses incurred or not incurred. Doesn't matter. They're going to document it. Short-term notes. So notes, bonds, bills work in the same function in which a company can create a note and put it into the marketplace. An investor can buy the note. The money that is used to buy the note is used by the company and infused capital to run their operations. Now, the way that the note works is that it has a fixed interest rate in which is a certain percentage of the value of the note. So let's say there's a note on the market for $10,000, right? So investor buys it, the company uses that $10,000, but is essentially a loan. So every year the loan matures. So let's say it's 10 years. So let's keep the number simple, $10,000 for 10 years at a 10% interest rate. So with that, every year that the loan matures within the 10 years, the investor gets 10% of that $10,000 back. And then when the loan matures, or the note matures anyway, they get the full face value of the note, right? If they see it through. So that's the way that notes work. And notes can be anywhere from 2, 5, 10, 20, 30 years. So it can be a short-term note or a long-term note that has to be repaid to the investor. When we're looking at long-term debt, we have, again, the long-term notes. And then if you owned land or a building, so on and so forth, you will have a mortgage. And so that will be listed under long-term debt. And lastly, we have the owner's equity, which is the cash investments made by the owners of or the shareholders of the company. Within this is listed as common stock. So these are the folks who have bought shares in the company and also have voting rights. They're not the first to get paid, though. Preferred stock has the priority of getting paid first. They do not have voting rights, but they do get paid first. A little riskier is I'll save that conversation for later. I was going to go down a rabbit hole with that, but that's not the point. So with common stock, we're only listed here as common stock for the balance sheet, and then any retained earnings. So after net profits, whether we paid out dividends or we invested back in the business, the net profit is the retained earnings. So when you see this listed on the balance sheet, this is something that you need to understand. And so when we talk about owner's equity, how is it calculated, right? So owner's equity is really calculated by the owner's investment, the common stock or the preferred stock, the cumulative profits, and minus the cumulative dividends paid out to owners. So consider the investment, the amount of money that's been invested, consider the profits that have been retained, minus the dividends you have to pay out to the owners that have invested in the company. Okay, so that is how owner's equity is calculated. So quick overview of what we just talked about. On one side of the balance sheet, you have current assets, cash, accounts receivable, inventory, also known as short-term assets, anything that can be converted into cash within 1 year. Plus the fixed assets, long-term assets. So these are the things that we own, machinery, equipment, buildings, so on and so forth. Minus, remember, the depreciation is minus within the fixed assets. Plus any other assets that are intangible equals the total amount of assets. Then on the right side, you have the list of the debt, current, short-term debt, accounts payable, accrued expenses, short-term, long-term debt as well, mortgages, long-term, plus the owner's equity equals total debt and equity. Now, at the end, I'll show you an example in a second. The total assets should equal the total debt because we have the land, because we took out a loan on the mortgage, right? So we have the equipment because we either financed it with debt or owner's equity. We have inventory because we financed it with debt or owner's equity. So that's why it should remain the same. So don't get overwhelmed. This is a balance sheet that is comparable. As you can see that we have 2017 up there and 2018. So ideally you want to compare with the firm's financial health and position over time annually. So as you can see on top, they have all of the assets, just like the overview. And then at the bottom, we have all of the debt and equity in the overview. And as you can see at the bottom, actually, check this out. Total assets, $800,000. And then you also have total debt and equity, $800,000, right? It should add up. Same thing in 2018. If not, there is some discrepancies that need to be reviewed. So I'm not going to go over this too much because I've already talked about the vocabulary, but this is a very great visual for you to understand how things are calculated. And so that the owner of JM Dalton, this imaginary company, can really see what their firm's financial position is. Are they recovering? Are they healthy? Do they owe more debt than they have ownership? Things of that nature. The very last thing that we're going to be talking about is the statement of cash flow. So the biggest difference between the balance sheet income statement and the statement of cash flows is that one, the statement of cash flow is not a formula expressed. We are just looking at specific activities within the business that generate revenue or take away or spend our revenue, right? So we're looking at where our money is coming and going, where is it flowing, where is it coming from? So we have a good eye on this. Now, as a small business owner of myself that's been operating for under 5 years, I think initially my financial statements really just, I stick to the income statement and the cash flow statement because it gives me the information that I need to know right now to make the best decisions for my business financially. I do believe, and this is all opinion, I do believe that the balance sheet is more for a little bit more advanced business who has a lot of assets and owner's equity. No one owns my business but me, so I don't have owner's equity. If it is, it's my money that I've invested into the business. I don't have a lot of assets. I do have a small loan, but it's not. There's no need for a balance sheet, right? So just considering that for those of you who are in business or starting business, don't feel overwhelmed with the need to have to do all financial statements, just the things that give you the information you need to make the best decision for your business. I talked about this earlier, the difference between accrual basis counting and cash basis. Again, it's visually there for you, so you can go back and look at this, but I won't talk about it now, but just know that the actual definitions are there for you right there. So as we get into cash flow activities, we're looking at three specific activities: operating, investing, and financing. And so in operating, we are both generating revenue and spending the revenue. Investing, we are spending the revenue, and financing, money is coming in. So this is why I like the cash flow statement so much, because it's telling us exactly where is money generated, where is it leaving, where is it coming, where is it going? Is it because we sold this? Is because we bought this? Is because we got this loan? And it's organized, very organized in a way that we can see the full picture of how our money is flowing within the business. Here is an example of a statement of cash flow. So as you can see, it is divided into three of the activities: the operating, the investing, and the financing. So within operating, you have your nets, you have your depreciation, profits before depreciation. Sorry, I need something to drink. The accounts receivable. All right, so here's a sample statement of a cash flow statement here. And as you can see, it's divided into the operating cash flows, investing cash flows, and financing cash flows, as stated before. So here you have your operating cash flows, which you're considering your net profits. That's where money is coming. You want to add back depreciation because depreciation is not a non-cash expense, which means that it needs to be added back to the cash flow statement in the specific operating in the operating section. You're going to subtract your account receivables because that's uncollected sales. That's money is not there. You want to subtract your inventory number and accounts payable there as well. You want to So here's a quick sample that I'm gonna go over quickly because it's pretty simple. This is the cash flow statement for the made-up company, J.M. Dalton. So you have your operating cash flows, your investing cash flows, and financing cash flows, which are the three activities that we're looking at where our money is coming and going. So within the operating cash flows, you're bringing in the net profit. So this is where we're generating revenue. And you're actually adding back the depreciation here because depreciation is a non-cash expense. It needs to be noted in the operating section. And then it goes into the profits before depreciation, which is the 90,000. You subtract the accounts receivable because this uncollected sales, so we don't have this money yet. And then you subtract the inventory, which is any increase in inventory that you have. That's money that we have, and then subtract it by the accounts payable money that we owe. As you see, it's 35,000 here, and then the total cash flows from the operations is $50,000. So we have about $50,000 of cash in our operating activity in our business, right? That's really good to know. When money is leaving us, investing, subtracting the gross fixed asset, which is also known as the original cost of the asset, whatever we bought. So this could have been a building, a car, what have you. And then we have the finance cash flow. So is coming in. So we have money from short-term notes if we lended out notes, increasing long-term any debt that we have there that's coming in from loans. We subtracting our dividends, which is what we paid out to owners. We have our total financing cash flows is 55,000. Any cash that we had on hand, and then you have the comparable beginning cash of this date, and then the ending cash of the latest date. Okay, so it's really just showing us in each and every activity where our money is coming and going, and how we should make decisions from there. So once a firm's owner understands the content of accounting statements, right, the information, the data that we get, the profitability, our financials, firm, our health, our ability to leverage cash within cash flow statements, the entrepreneur can now make better decisions that about in regards to the business that impact the business in a positive, hopefully in a profitable manner. And so the thing that we're really deciding is, can we pay our debt? Can we cover our costs? Can profits be generated after costs so we're not breaking even? Can we use our debt to leverage to infuse capital? Can we use our owner equity to? So in order to make those decisions and in order to find those answers, these accounting statements, these financial statements give us the information and data that we need to make those informed based decisions. All right, that's chapter 10. I will upload this PowerPoint to the file section. So just in case you want to review the vocabulary, you can. I will see you in chapter 11.